Hi and welcome to the Martin Bell Show. Hopefully you've been keeping well, and in today's video I'm going to be reading from the Daily Mail Online on the money section, and we're going to be talking about why do a fifth of savers quit investing, and some of the reasons are as followed: wild markets, financial losses, and jargon that they do not understand is blamed for the reasons why they give up. So it's saying here some of 55% of savers are not confident about the jargon that is used. So this is a problem of knowledge. So if they gain further knowledge and understandings of terminologies and acronyms, or the moulding of how it all works, if people did more research into the matter, then they wouldn't be so perplexed by the jargon and terminology that is used. So you have to put in a bit of effort to gain knowledge in the understandings. So it's saying here market volatility and underperforming investments deter savers. So volatility puts people off, but that's the reason why you can't be short term and you have to be more longer term. And before I go any further, this does not constitute as financial advice. I'm not a licensed professional. This is just me giving you my perspective for motivational or educational or inspirational purposes only. Please do your own due diligence before making any investment decisions. So it's also saying here a third of people have tried investing. Only a third of people have tried investing and stuck with it. So 33% only stuck with investing. So that is not many people. Making mistakes is inevitable, and that is true. And whenever you start something new, you're always going to make mistakes. And that's why you shouldn't put large sums of money in straight away. And you should test your knowledge and your understanding with smaller sums of money. I'm not a trader, so I'm more of an investor, so I'm more longer term. So I don't do any of that day trading stuff. But you can learn from them. Tell us your investing clangers below. Okay, so saying here 1 in 5 people have tried and abandoned investing and blame losses and volatile markets for pulling out their cash, new research reveals. The challenges of keeping on top of the information to make good decisions and understanding the jargon were often common reasons for giving up on investments. Investors often make mistakes, but learning from them can help you to do better in the future, and that is true. And that's why most of my investments are going to be going into ETFs, into broad markets, and some narrower ETFs such as property, or maybe a consumer staples ETF or renewable energy ETF or something like that. And I will be having some single stocks, but not too many. So it's saying here the key is to take a longer term view and don't panic. That is true, according to broker Charles Stanley Direct, which surveyed 2,100 people across the country. Some 55% of savers are not confident about understanding financial terminology, and the firm gives a rundown of the common jargon what it means below. Charles Stanley found 35% of people have tried investing and stuck with it. 19% have done it but stopped. 25% would like to invest in future, and 15% are not interested. The rest did not know or preferred not to say. Among those who have dropped their efforts to invest, 40% were concerned about market volatility. Well, that is true. There's always going to be some volatility in the markets. But if you hold out, in general, as long as the fundamentals remain solid, you should be okay, and it should recover in the future. While 32% said that investments weren't performing as well as they wanted to, or they were losing money. They've also got to have realistic standards of performance as well. Some 20% couldn't keep on to the top of the data, 15% decided investing wasn't for them, and 14% found it was too time consuming. Well, you do have to put in some effort. If you actually want to do this, you may actually have to put a considerable amount of time in. If you're very brand new, you're going to have to invest quite a considerable amount of time to gain the knowledge and understanding of investing. You might have to, I'm not saying you are the stereotypical EastEnders watcher, But if you watch EastEnders or that type of programming, you may actually have to give that up, and for something better in the future you have to sacrifice something to gain this knowledge. There has to be some sort of sacrifice. So meanwhile, 8% said that they have stopped when they achieved their financial goals. The research also revealed a lack of confidence among those that currently invest, with 26% admitting they don't understand the different levels of risk and how to minimise their chances of losing money. And 51% said worrying they might make a bad investment. And there's always going to be that doubt there, but there are other vehicles out there such as ETFs and blue chip stocks, which are less likely to do bad. So there were gender differences, with 31% of women choosing not to invest because they had no idea where to begin, compared to with 20% of men who said the same. Well, I think it's more of maybe because men like numbers more. I don't know if it's a stereotypical thing, or I don't know why that may be. I'm not 100% certain, and maybe some factor to do with that. Some 16% of women thought financial terminology was too confusing, compared with 10% of men. Charles Stanley asked savers what would help them improve their understanding of saving and investment options. Some 38% said the simplification or removal of jargon would help, but that can't happen, I'm afraid. That just can't, because there has to be terminologies for things to be understanding, such as P/E ratios, that's price to earning ratios, and that's the saying about the price to the earnings ratio. Basically, how are you getting a good deal or a fair market deal on the stock? So the higher the number, depending on the industry, the lesser the deal is not as good. So there has to be terminologies for this to happen. They can't just get rid of all the terminologies. People will actually have to put in the work to actually understand these terminologies. You can either do this by watching YouTube videos, or getting books, or taking an accounting class or bookkeeping class. Well, probably not so much bookkeeping, but an accounting class, or YouTube, or an online lecture. People are actually going to have to put in the effort. It's not going to be done for you. Nothing happens in this world. You're going to have to put in the effort. Saying here, 34% wanted more financial education in schools, and yes, they should do that, but that's never going to happen, because I don't think that will ever happen. It's never happened in life. If you would, if you know what the problem is, why would you want the schools to do it for you? If you now know the problem is a lack of understanding of jargon, why dictate for the schools to do it for you if you can then do it yourself if you're in an older age? Now that you're probably not in school, you're at an older age, you should now put in the effort for yourself to learn this information. 20% call for more regular communication from firms, 18% preferred to receive education from their employers. Depending on what employment options you have, it's not the employer's job to give you financial and investing advice. Depending on what area you're in, you can do this research for yourself. This is all on YouTube and on the internet. You can all learn it for free, and I think people want it done for them. But I do agree with them that financial education does need to be taught more in school, and balancing and money things like if you take a loan, how much this will cost you, and how figuring all this out. Really important things. In addition to being willing to do some homework on the basis of investing, one of the keys is learning from your inevitable mistakes, and that's very true. He wrote about the experience and what he learned from other investing mistakes here. And cites his 60% HMV loss whenever the topic of investing blunders comes up today. Tell us about your investing gaffes and what you have learned. See, right, Rob Morgan, investment analyst at Charles Stanley Direct, says the most important thing is to take a long-term view, and that's very important. The longer term that there is, the more chance of recovery, and you're going to sleep a lot better at night. If you're trading, the volatility will keep you awake. Some volatility is good because it enables you sometimes to get a better deal when things drop, if you have some cash set aside, if you know eventually it will recover. For example, I bought the FTSE 100 when it went down due to what's happened in the world. It gave me an opportunity to get a better deal and put money into these companies, and it will pay off dividends, literally off in later in life. And I have set that to re-drip into itself, which is going to get it into get that snowball rolling. So volatility is an inevitable part of investing, and it can be very scary when the markets fall. And a common mistake is to sell when this happens due to the fear, which can be the worst thing to do. And it is true. And this is another reason why I say to start off with small amounts. The reason being is when you're likely to buy it, it's likely to drop a bit in price, and you're likely to go in red. And that's why it's good to start off with small amounts of investing, so you get used to the feeling of your portfolio going negative from time to time. It will go negative. It is only a matter of time, and mine has gone negative and positive, but overall it's heading in an upwards trend. Investors must be prepared to hold their nerve and ride the ups and downs. Keeping invested is usually the best strategy. Historical evidence shows that if you invest for a 10-year period, there's around a 90% chance of beating the return of cash savings with investing in a global stock market, probably an ETF. Morgan adds, when it comes to investing, where there's a lot of jargon to get your head around, so it can easily become overwhelming. But this shouldn't mean that people are put off, particularly as cash returns are so poor at this moment. And technically they are actually negative because the interest rate is 0.1%. Inflation's 0.6%, so we technically have a negative yield of 0.5%. What is needed is the time and confidence to understand some of the terms involved and the level of the risks you want to take. Charles Stanley offers the following guide to common terms for the beginners. Shares, also known as equities, are the units of ownership of a company. Shareholders benefit from any rise in value of the company as well as profits distributed in the forms of dividends. And that's a dividend is a form of payment for ownership of the company. Say if the dividend was 50 pence per share, so every share you hold before the ex-dividend date, you get 50 pence, which is really cool. And that's really a lovely form of payment to help you in later form of life. And that's the main reason why I'm investing, is for the dividend payments. Because otherwise you have to sell your position to gain ownership in the company. I mean, you have to sell your ownership to get the money out, but then you own less ownership in the company, which is something I'm not keen on. So we're saying here, bonds. Bonds represent the debt of a company, government, or either equity. Bondholders accept to be paid interest and have their original capital returned at the end of the bond term. And this could be a government bond, something called an emerging market bond, so that's more up and coming countries that are developing but still having a lot of problems at this moment in time. You have a corporate bonds, and you have short-term bonds, which is literally means the time left is the bonds are almost up, and the term, so the interest rates may not be as good. But you have to do your research because interest rates are quite low. So from the government bonds, they may not be a great thing, because in the future, if interest rates ever go up, your bond won't be doing as well, as you could be more into equities. So funds provide access to lots of shares, bonds, or other assets in a convenient package, so investors can gain broad exposure to a particular area or theme. True, and that could be an ETF as well, not just a fund. The stock market is a marketplace where shares can be bought and sold by investors. The FTSE 100 is the most well-known stock market index in the UK and is used to track the performance of the 100 largest listed companies. And some of them are AstraZeneca, BP, Shell, Unilever, and I can't think of any more at the moment off the top of my head. Like really big ones. Diversification. It is where investors build a portfolio of various shares and other assets so that they are not overly reliant on any one investment and other areas are performing well. And this is why it's also important, because you may not get such as higher highs, but you won't get lower lows, but you get more stability and you sleep better at night, and you don't have as much anxiety. You shouldn't have too much anxieties of that. It reduces that by having a diversified portfolio and reassurance if something doesn't do well and you've got other areas to make up, and maybe there's an opportunity to buy of that one that's not doing too well at this moment in time. It may recover in the future. So let's have a little brooksy at where the best rated comments are. And let's see if they're any good. They're saying here, don't contact any of these people if I ever mention them. They're saying here, I think the problem is online platforms with nervous investors being able to follow their portfolio like it's a football match. True. My advice is, once you have invested in a diverse blue chip portfolio, look away and ditch the investing app and find a hobby. Not as easy as it sounds, but I agree, and I do agree. It's not good to keep checking your portfolio every 5 minutes, because that volatility can impair your decision. But it is good to keep an eye and track of it, because it's not going to go up massively in a short period of time. It's just buy it, set it, forget it, and then reevaluate. And obviously if any news comes up and changes the fundamentals, then do your research and then make a decision if you want to hold out, if they can fix the problem, or you're going to sell out of the position entirely. But it's not good to keep checking it every 5 minutes. I normally check mine maybe like once a day, just out of curiosity. And then obviously once I'm going to do a purchase, I also check then. So not too often. So largely true, but I wouldn't choose smaller companies in emerging markets for at least half of my portfolio. Much higher returns over time. Yes, but yes, I agree. I wouldn't have half your portfolio in emerging markets. That's a very high chance of risk, because emerging markets are very risky, and that's why they yield quite a lot, but there is a lot of risk there, and there could be possibilities of default as well. So if you found this video useful and you want to learn more terminologies, then please feel free to subscribe to this YouTube channel and click the bell notification button, and you get notified when I next release a video. I also play video games where we talk about investing, and sometimes we just chill and just play some video games, as well as we follow my portfolios as they grow over time. So I look forward to seeing you then. Take care, and I'll see you all soon.